Welcome everybody to the session today. We're going to talk big picture, the portfolio, get you set, get you fired up, get you ready for picture, the portfolio, get you set, get you fired up, get you ready for 2018. So 2018 will be hopefully a better year for you, or if you had a good year yesterday, even better year. And Happy New Year, everybody. So we are going to talk about a plan to make $5,000 a month. We're going to be talking about a portfolio. What do we do? How do we set it up? How do we trade? What do we trade? Say, Dan, it doesn't matter what we trade. Just get long. The market's going up. Get on the Trump bandwagon, right? What if we don't go up this year? Are we going to go up 20% every year now? If you drink that Kool-Aid, I ain't buying it, right? I refuse to buy that Kool-Aid. But who knows where the market's going, right? Who knows? But again, you need to start if you're thinking of you want to make $100 a month, $5,000 a month, $10,000 a month, $100,000 a month. It's got to be a plan. How are you going to do it? Dan, I'm going to get lucky, or Dan, I'm just going to stay long. I'm going to stay long the market, and that's how I'm going to do it. So that's what we're going to talk about today, a plan to make $5,000 a month in 2018. This is for educational purposes today. This is going to be the launch of a new class. We're going to do a 2-week class. I really thought this would be appropriate for the beginning of the year 2018. You know, we can jump into strategy, short-term, long-term, what's working, you know, all that stuff. But I think if we don't start with the perspective, a plan, or where are we going, or how do we do this, or what if the unthinkable happens this year? What if we don't go up every day? What will we do? Right? What if our covered right isn't working like a cash machine, or our put credit spread isn't working? I'm counting on that money to go to Florida this year. What am I going to do? And I think it's important to address this at the beginning of the year, how to make a plan and how to tweak a plan and how do I pick my strategies and how do I allocate my capital and all that. And that's crucial, right? You don't just get in there and say, oh, get long, right? So this portfolio class is going to be a 2-week, get us ready for the year. It's going to be 4 classes. It's going to be January 17th. Oh, there'd be a typo there. Did I put that? January 17th, Wednesday, January 19th. Every day can't be a Wednesday, can it? No. January 19th, Friday. January 24th, which is a Wednesday, and January 31st, which will be a Wednesday. Class will be $197. All classes will be recorded and archived. Class length 1 hour to 1.5 hours per class. And it's going to be focused on the concept of how do I make $5,000 a month? And you know, you can, whether that number to you could be $1,000 a month or $100 a month or $50,000 a month. But the principles and what I'm going to go over will be something that should be able to guide you for 2018. All right. So that's going to be the class. It'll be starting January 17th. It's 2 weeks from today, and today's kind of the preview. All right. When you're thinking of the world of durations, yields, and capitals, just a couple things I want to point out. Because when you get let's say to make $5,000 a month, and I'm just giving you from my experience working in the community, myself, other students, on $50,000, right? They come out to about $5,000 a month, right? Because you're putting 2.5% of 50,000. That's $1,250 a week, right? $1,250 a week times 4, boom, 5,000. But to make 5,000 a month, so what am I touching off right off the bat? When we're talking about making $5,000 a month, is duration a consideration on your trades? Yeah. What if you're doing trades that are 45 to 65 days out, butterflies, iron condors, whatever? To make $5,000 monthly, in my opinion, conservatively, if you're looking at that 2 to 2.5% a month number, you need capital of $250. Dan, I don't know if I agree with that. I do it on less. Hear me out. When I'm talking about 50 grand here, I'm not talking about going over 50. Are you with me? I'm not talking about going over 50. I'm talking about no overlapping trades. When you're doing 45 to 65 days, you are not getting out of the trade in 7 days. It's not happening. You're going to be in these trades a month, right? So this is 4 trades a month. This is about 1 trade. You say, Dan, well, I do these 45, 65 day trades, and I put some on every week. I overlap them. I get some off, but here's what you're missing. Here's what you're missing. You're using a lot more capital because you're going to have overlapping trades on, right? Here, you're not going a penny over 50 grand, probably. Why? Because you're getting the trade off every week. Here, yeah, you're going to have trades coming off every week, but you're going to have quite a bit of different trades on. So anyways, that's what I found is usually when you're doing 7 to 15 days versus 45 to 65 day trades, you need 5 times more capital, right? And this is pretty accurate. If you say, Dan, you're wrong, email me, and if I'm wrong, I'll give you Portillo's Italian beef because I'm betting you calculated it wrong, right? All right? Take me up on that. Italian beef with sweet peppers. Sweet peppers. All right, so everybody get that. So what am I'm just pointing out something right off the bat that when you're talking portfolio considerations, duration matters, right? Now, someone might say, hey, Dan, you know what? If this is the case, I'll just do the shorter term trades. Well, how much hot sauce do you want to put on your burrito at the burrito buggy or whatever restaurant you go to? The point is this. We're going to talk about in this portfolio class a little bit of balance, right? You can put some shorter term trades. I'd like to see a balance between shorter and longer term, but if your personal preference is longer term, or if your personal preference is shorter, you can do it. But there's pluses and minuses. Shorter term trades are going to be more price risk sensitive, a little more work on those trades, but hey, it's a good deal in terms of capital. Longer term trades, you don't make as much, you don't run into as much trouble, but there's pluses and minuses of both, right? One isn't better. So that's a beginning point for this conversation. When you're talking $5,000 a month, wouldn't your first question be, hey, Dan, how much capital, how many of you have so much capital it doesn't really matter to make $5,000 a month? It doesn't matter. How many of you have unlimited capital, right? How many of you have Mark Zuckerberg money where it just doesn't matter? Not many of you probably, right? So most of you, if I said, are you concerned if you're trying to make $5 grand a month, or if the number's 1,000 a month, or 500 a month, or 10,000 a month, or aren't you concerned about the capital you use? Are any of you concerned about the capital you use to try to make $5 grand a month? Yes or no? Any of you look at that? Or do you guys just, okay, good. Somebody's sane here. It takes women to be sane, isn't it? The first 2 people that say yes, Sarah and Maureen. See, women are much more sane traders than men are. You heard it here. All right. Our short puts, were short puts low maintenance in 2017, yes or no? If you sold puts, out of the money puts, way out of the money puts in SPX, would that have been low maintenance in 2017? Yes. Would selling out of the money put credit spreads in 2017 be low maintenance? Easy breezy, love your wife, everything? Yes. Keep it up, Dan, keep it up. Would cash secured puts and covered rights in 2017 be easy, go to the beach and rub your belly? Yes. But let me ask you a question. Does low maintenance, easy, no work, does that have anything to do with the risk of the trade? Does low maintenance, easy, loving, rub your belly have anything to do with the risk of the trade? Here's the answer. No. In other words, is a short put, a cash secured put, a put credit spread, covered right, all those easy 2017 strategies. If you asked a trader who actually understood what he was doing, are those risky strategies? Are those risk reward? Are those good risk reward? What do you think? Are those conservative strategies? If your answer is yes, you've been smoking stuff you shouldn't be smoking, right? Listen to me. You've been smoking stuff you should not have been smoking, right? The market's gone up and rubbed your belly for you. But if you're going to tell me with a straight face, cash secured puts and way out of the money put credit spreads are low risk, you need a good options course, right? So what am I saying? We all want low maintenance, right? We all want low maintenance and easy, just easy. I don't want to have to do anything. Just give me the money. But here's what's important, folks. You need to look at the risk, because we might go down, and I'm going to say something blasphemous. We might go down in 2018 at some point. I know I could get put in jail for saying that. I understand that. But I'm going to take a shot here. We might go down, right? And everything may be good. But the point is, you still have to understand the risk. And I'll talk about some of these strategies in a general sense and just how I would do these in 2018 in a sane manner, right? Now, other personal considerations. Adjustments. Do I want to adjust a trade or not? Why would you adjust a trade? Adjusting a trade is because you're trying to buy more time till the market comes back. Adjustments are good, but some people don't like adjustments, too much work. And then capital. How much capital do I have, right? And when you're thrown in the capital, duration is a big deal in terms of how much money do I want to trade? Well, what are you looking to make, right? Now, again, obviously, you can have a plan how to make $5 grand a month, but you still have to learn the craft. Does that make sense? You have to learn this. Now, work schedule is another thing, personal considerations. How much time do I have to watch? And that's a determinant, right? Work schedule. Will I have the time to look at something if it's a shorter term trade? So these are things to consider. Outline. Market considerations for capital and strategy allocation. So 3 things that I look at that will determine, and we'll get into this more in the class, what type of butterfly or iron condor or calendar can I trade in certain market conditions? You know, you can trade any of these strategies, any market condition, but there's little tweaks. You know, am I going to trade, I don't know if I trade an iron condor at a 9 VIX volatility, but I would. Say, Dan, are you crazy? You would trade an iron condor at a 9 or 10 volatility? Yeah, sure I would. I do a shorter duration, and I would give me more room on the upside. Or are you allowed under the laws of the Geneva Convention? Could you do 10 put credit spreads and 3 call credit spreads? So there's ways to do this, but these are 3 factors: market considerations for capital and strategy allocation. I look at the price level of SPX, I look at the VIX level, and I look at the speed of movement, standard deviations. Based on that, that will help me. How do I allocate the capital? How do I allocate the capital to different strategies? So I look at SPX. As you look at this chart of SPX, what do you see here since the beginning of the year? Really, what we started out was last week is we had about, this week, believe it or not, except for today, has been pretty quiet. Would you agree? It's basically last week. We had, 5 days last week where we moved, I'll tell you. We moved January, the first day of the year, January 2nd. We were January 2nd. So I'm just talking last week. we closed at 26.95. Going last week, Tuesday, Wednesday, Thursday, Friday was the first 4 days of the year, up 22. This week has been quiet except for today. You agree? The third, 27.13, up 18. The fourth, 27.23, up 10. The fifth, which was Friday, 27.43, 43, up 20. And basically where we are today is all because of today. You agree? Basically what the market's up today is what it's, you know, in other words, last week we were up 22, 32, 40, 50, 60, 70 points. So we say, is that a lot? Is that a little? Well, what's a one-day standard deviation? A one-day standard deviation in here is about 10 or 11 points. Dan, what does that mean? With about an 8 volatility, a one-day standard deviation on these days is about 11 points. What does that mean? It means that there was a 68% chance that we'd be up 11 or down 11. And on 3 of those days, we almost moved double that. So very low probability that we would do that. Very speed days, very fast days. And these are which are more challenging for income traders when you have that one-way speed. And speed is when, you know, when you're getting like 2 days out of a week or 2 to 3 days out of a week where you move what, standard deviation and a half. That's fast. And so when that stuff happens, we tweak things a little bit. We're more concerned how we set up our Greeks on these strategies and stuff like that. So it's important we look at the levels of the market when we're putting together a portfolio, and we also look at the speed. Right? Last week, really fast, we had 2 moves that were almost 3 moves, 2 standard deviation in 1 week. Does that happen much? No, no. And once we get that, it's like, what do you do when you're on the highway and you get 14 inches of snow? You slow down, maybe move to the side of the road, maybe stop at the library and kill some time. You know, it changes things. So looking at price, looking at the speed of the movement, and then looking at the VIX levels, and this is it. I forgot I had it written down. I had it written down. It would have saved me all that writing, but this is what I just told you about, right? SPX this year. So you're saying, you know, 2 standard deviation move, almost two. This is all last week. This week has been pretty tame, except for today. I know we're up more than this. This was just taken a little bit earlier. VIX. What's the VIX levels? Does that have anything to do with how I set up my portfolio? Absolutely. How I allocate strategies to this. And really what I'm going to give during this 2-week class is just a very simple, literally, when the market's kind of at these levels, pick one of these 2 vegetables to do, pick the, you know, be very simple, pick this and this, but we'll put you on the right path for navigating through 2018. Today, I'm just kind of bringing up a big picture, things to consider, but as the solution over the next 2 weeks, I'll give some different categories of strategies and some metrics, and then as you're looking at a monthly basis, you can kind of see where you need to kind of steer the ship. But it'd be something very easy, very few strategies. You can limit the adjustment. So I'm trying to give a very simple plan to keep you on path for 2018, especially with how you do these strategies. People will say, well, Dan, you can't do this strategy during this time, or this strategy got killed the last 2 months. You're nuts. Depends on how you trade it, right? There's not one way to trade everything. So that's that. Diversified options portfolio. So the big picture is the diversified options portfolio, how to construct the portfolio, how to divide it into 3 key areas, what number of trades, how many trades should you make, right? What about a risk management plan for each trade, And what about some black swan portfolio protection? What vehicles to trade? I like, overall, I like diversified products like SPX and RUT and some of your, some of your very liquid stocks, your Amazons, your Apples and those. But I trade a lot of SPX, RUT, and some of your liquid stocks. I think that's really all you need to trade. You can trade some futures options, and we can talk about that. But what is this portfolio, what it look like? 3 parts. Part 1, a long portfolio. This would be your covered rights, cash secured puts, long diagonals, put credit spreads, out of the money put broken wing butterflies, trades that generally do very well on the upside, trades that have very little or no risk on the upside, plenty of risk on the downside. How many of you do trades in the long portfolio in 2017? How many of you have done some trades from the long portfolio, some of these strategies, covered rights, cash secured puts, long diagonals, which are basically covered rights without stock? Maybe I'm buying a 6-month or 12-month option at a 70 or 80 delta and selling an out of the money call. Most of you have put credit spreads. We do these out of the money put broken wing butterflies in our community. They would be in this category because there's very little risk on the upside and they generally do better. So most of you have done that. How many of you are feeling the only trades you want to do in 2018, be honest, should come from this category? How many of you, because of the direction of the market right now, feel like these are the only trades I want to do? Any of you? Probably all of you, right? But I mean, I'm saying I don't think that's the answer. But when we talk about this concept of portfolio next week, this is important, long portfolio, right? And there's nothing wrong with having some of your portfolio. It could be up to 30, 40% in these types of trades, right? And again, we're monitoring the market. Agree? We're over the 200-day moving average. I mean, all indicators are we still haven't turned down. Agree? But here's the point. I believe in waiting for the market to turn versus predicting. How many of you have been short deltas for the last 400 years waiting for the market to go down? None of you will admit it, but many of you, right? Every time we go up, sold. We're going down this time, sold. No, this time, sold. No, not this time, sold, right? Trade, I believe in trading what the market gives you. If I'm in the ocean and I'm on Huntington Beach and I'm doing surfing on 5-foot waves, it is what it is. But Dan, tomorrow's going to be a thunderstorm and you got 10-foot waves. What are you going to do? When the 10-foot waves come, we'll deal with it, right? But right now, it would be safe to say we're still in an uptrend. Now, we could be at the last 4 hours of an uptrend, but we're in an uptrend. So in other words, I don't do a lot of, because we're working on consistent monthly income, we can't start putting our opinion in. Oh, I had a dream last night. I ate pizza. Tonight's the big one. That's not trading. Part 2, and this is probably what we do a lot of in our community, even though we do quite a bit of these, income. More two-way risk than the above. Part 1 strategies have basically one-way risk. Part 2 strategies have some two-way risk. Calendars and double calendars and different versions of butterflies, iron condors and double diagonals. These would be trades that generally have some risk in both directions. You with me? How many have done those type of trades over the year? So these would be 2 different portfolios. Okay. And then part 3 of your portfolio, speculative. That's the one we all love the most because we're all gamblers, right? A little bit. Long calls and puts, long vertical debit spreads, directional plays based on earnings, directional plays based on technicals or fundamentals. And so you have 3 parts of the portfolio. And based on what the market's giving you, the price of SPX, the VIX level, the speed of the market, where these products are, it's how I might allocate dollars among these. But we have students that'll just trade the income part of the portfolio. We have students that'll just trade the long portfolio strategies. But we have probably a majority of our students will trade some strategies from both of these two, and then some will dabble in this. And you say, Dan, what students trade more in the part 3 speculative? The ones that are good at it. Isn't that a tough answer? The ones that are better at it. So this is kind of the big picture, 30,000 feet up in the airplane. You with me? And this is what we're going to navigate through next week is when, you know, right now, would we have a little more capital in this part of the portfolio? Probably. But at some point, we may switch some more over here when the VIX and other levels change. Franco, are you going to address part 1 today? I'm going to go over an example of part 1, but in the 2-week class, I'll be going over a little more of these overview of them, but I'll have an example of each of these today, kind of a relevant example that I'm looking more at in today's market. Franco, good to see you. Franco, you're the Franco runs the school. Franco, you're the Franco who runs the school in Rome, don't you? Is that you? Is that my Franco? Yeah, I think that's Franco. Maybe not. Franco, you don't live in. No, different Franco. Franco, where do you live? There was an Italian guy who he runs a school in Rome. All right, Franco doesn't do that. Franco, would you like to? You're living in Belgium. Maybe you want to. Would you like to run a school in Rome? Okay, maybe that's the question. All right. Outline strategy considerations. So now we start with the long portfolio. So long portfolio is basically risk in one direction. I call them couch potato strategies because why? If you've done a steady diet of put credit spreads, out of the money put broken wing butterflies, cash secured puts, covered rights for the last 2 years or so, would you call those couch potato? Most of the time, could you have sat on the couch, ate some potato chips, and relaxed? Yes. What are those potato chips? Do they still got those? When I was a kid, we'd have the potato chips that they would stick in the circular tube. What were those? I didn't like Pringles. How many of you were tortured with Pringles as kids? My mom would put those in my lunchbox when I went to high school. So long portfolio, these are risk basically in one direction. Duration. What duration do we trade? How do I pick the duration? Some of it is your personal nature, right? Your work schedule. But if I'm just looking, all things being equal, how do I look at duration? Volatilities, right, are part of it, right? If it's like now with volatilities very low, I don't want to do 60-day short Vega trades. I want to do a little bit shorter term. It's not worth me taking the volatility risk. So duration would be based on your personal preference, but duration would be based on the strategy you're doing and the volatility levels. Should I be long or short Vega trades? With the volatility low, should we be doing long Vega trades or strategies that benefit from volatility going up? I still think you do a mix. I think you do maybe a little bit more in long Vega strategies, but you can do short Vega strategies. You just tweak them. You just don't do them the same as you would do them when the VIX is 12. And we'll talk about that over the next 2 weeks, the type of strategies that I'm doing now and teaching. So, and then again, it's real important that it doesn't matter what you call your strategy or how you set up. It's ideal Greeks. How many deltas, long or short, do you want to lean on each contract or each strategy you're doing now? And so looking at the beginning Greeks is important. And so based on the price levels of the market, volatility, speed of the market, and the strategy, we'll talk about what would be ideal Greeks, right? So again, this 2-week class will be a good general overview of how do we put this thing together? How do we kind of navigate through 2018? I think it's crucial. If we don't start off on the right foot, I mean, you're going to be rowing upstream. Outline. I'm going to go over a few examples here in a second. I'm just going over some of the basics. And like Brett said, short duration double calendars, I'm going to go over an example of one, are working like gangbusters right now. Outline income portfolio, these would be strategies that have risk in one or two, usually two directions, like your butterflies, calendars, iron condors. Duration will depend, again, on your work schedule, on the VIX levels, on the price levels of the market, and we'll teach you that. When you're deciding, you're looking at your income portfolio, what's the mix of long Vega and short Vega? You know, and I think VIX is I don't trade a lot of VIX, but I use it as kind of a measuring point based on the level of the VIX, where I want to allocate capital. And again, the Greeks. And then the last slide before we get into some strategies, speculative strategies. You know, you might do them around events like earnings or using technicals. And how do you want to set the Greek? So kind of the big overview of that too. All right, strategies. In the long portfolio, you've got covered rights, cash secured puts, long diagonals, put credit spreads, broken wing out of the money, put butterflies, ratio iron condors or calendars. If you can, can you guys think of any other strategies that I missed for the long portfolio, or we'll call them couch potato strategies, especially over the last 2 years? But again, don't think because something a couch potato or it's been easy, it doesn't mean it doesn't have a ton of risk. So you don't want to confuse the two. Are these easy, riskless, low maintenance in 2018 because of the last 3 years? Don't count on it. Right? You're going to be careful how much dough you pour into this, and this is what we're going to talk about next week. John Dory says covered strangles. I wouldn't call those long portfolio, because if you're selling a call, covered strangles, what are you talking about? Like, but if you're talking strangle, you're selling it out of the money call and put, right? So you'd have risk on both directions. Or are you talking about something like, you ever see this, like buy stock or buying in the money call and selling out of the money call and out of the money put against it? Is that what you're talking about, John? That would be, yeah, you're right. That would be a long portfolio if you're talking about like buying stock or in the money call and selling an out of the money call and an out of the money put against it. Yeah, that would be like in a slower moving stock, not a high beta stock. Maybe something like a Johnson & Johnson or IBM that doesn't go up too fast too soon, and you're trying to milk you got an old cow and you're trying to get more milk out of it than you should. So you're selling out of the money call because it's not going up too fast, and you also selling out of the money put. You're not as worried about the downside, but you're a little more bullish on the stock. You're looking to buy more stock if it goes down. But anyways, yeah, that's a good one. And so these are your long portfolio strategies. And here's how I would do one right now. And I'm not promoting this example. This is an example of one. So here's an example today with Apple. I just used Apple. But you could do this on SPX, SPY, any other stock you like. But this would be an example of how I would do it. And I'll tell you why. So here's Apple at about $175 today, Jan 11, and I'm going to buy one April 20, 160 call, right? So the delta of my call, I think this was like a 74 delta. It's in the money. So I'm buying a April 20 call. So it's at about 100 days out, 100 days from expiration. And I'm selling a Jan 26, that's only 15 days out, 175 call. The reason I'm selling this one, again, this probably, should have probably used a clearer example, but this is fine. But the reason I sold Jan 26, because this is the last expiration that won't be affected by earnings. In other words, Apple's earnings are coming the week after this. Do you agree? So I don't want to be affected by the storm called earnings necessarily. So this will be selling an expiration that won't be affected by earnings, and then buying the April 20, 160 calls. But, you know, whether I do this in SPX or SPY or IWM and RUD or a stock I like over the next year, what I like about this is a couple things. This is much cheaper than doing a covered right. Why? Because I'm buying an in-the-money 6-month call versus stock, so it's a lot cheaper, right? And I'm selling an at-the-money call, generally in stocks or indexes right now, because I want a little more downside protection. I'll sell the at the money. So this is going to be a much cheaper way to do a covered right. But what I really like about it, not the fact that it's a positive theta, but it's long vega. A covered right, cash secured put credit spread are short vega strategies. And what does that mean? It means if the volatility goes up, they lose money. This is the only covered right type strategy that makes money if the volatility goes up, right? Doesn't mean, if the stock goes down, you lose, but you're going to lose less because you're long vega. You got some benefit from your long option. Does that make sense? So this is the type of trade, and I'll talk more about this in the next 2 weeks during the class, that I would be configuring a long diagonal in Apple. You with me? Not a long diagonal. Why? Because to be long vega, when the VIX is so low, right, and I'm putting much less capital on the table, if I'm doing maybe a 6-month leap or 6-month option, and I'll give you some more information how I would do that. Again, I don't have a lot of time today to go into risk management, but this would be just a fraction of the margin would be what you pay for it. So if the debit is $1,573, the cost, the margin, the risk would be $1,573. I can guarantee you're not doing a covered right for $1,500 bucks. So would this require a lot of margin? No, your margin is your debit. And I'll talk a little bit on some of these strategies, the plan. Seda said, what happens if Apple remains at 175 on the short strike on January 26th, you will lose 73. Well, again, no, if it closes at 175, you win the lottery, right? You win it all. But the more important thing is the plan, which we will talk about. So this is an example of how I would do a long portfolio strategy. Now here's strategies from the income portfolio: iron condor, butterflies, calendars, double diagonals. And so here's SPX. And again, you could see this meteoric rise up in SPX. And I'm going to go over. So this is one we've been doing, and here's an example of something I'll be talking about during the 2-week class. But this would be an income strategy, and this has been working wonderfully the last 5 months that we've been doing it. Leo said, I did a similar trade, a calendar versus a diagonal Tuesday with Amazon. Okay. And he closed it after the bell this AM for a 7% profit. Yeah, so again, these long diagonals allow you to put much less capital on the table and less risk than a covered right, and much higher yield potential. And like Leo said, you get an opportunity to get out quicker. Nil said, Dan, when you're generating 5% a month on 50K, is that 50K fully invested? The answer is no. I mean, generally in that 50K, you might have 3,000 to 5,000 nils that is for maybe extra that you might use for adjustments or something like that. So maybe 10% is on the side. So it's really that other 40 grand is generating the 5%. So you're really making more than the 2.5%. So here's an example of something that's been working pretty well the last 5 months, a shorter duration double calendar. My short is 15 days from expiration. My long is 29 days. Here's an example today. Matter of fact, let me just see the prices here. And the strikes, 27.40 and 27. I actually did this live today, but I did the 27.40 and the 27.85. I did it live maybe about an hour ago, but this is an example of one. So here's the trade. My longs are 29 days out, my shorts are 15. And this is kind of an iron condor alternative in a low volatility environment, which we're at, with volatilities under 11. Because an iron condor, the foundation of an iron condor is selling an out-of-the-money call and put. The foundation of a double calendar is selling an out-of-the-money call and put. So here you have, I'm buying 1 Feb 9, 27.75 call. I'm selling 1 Jan 26, 27.75 call. So here's your short call. And this is all with SPX at 27.58. On the put side, I'm buying 1 Feb 9, 27.40 put, selling 1 Jan 26, 27.40 put. Here's your put side. So here's your graph, here's your zero line, and so you have this kind of an iron condor looking graph, but your Greeks are, the VIX is 9, SPX 27, 58, 59 when I put it on. Your deltas are close to 0. My theta is a little bit positive, and I'm long Vega. So if the volatility tips up a little bit, I do well. So this is good in a, in a lower volatility environment. But this would be an example of what we've been doing and the type of strategy, and I'll explain the reasoning of it a little more in the class. Strategies in a speculative portfolio. Earnings strategies, butterflies, iron condors around earnings, also pre-earnings calendars, directional plays based on technicals using out-of-the-money calendars or butterflies or vertical debit spreads, ratio back spreads. There's other stuff. And here'd be an example of a ratio back spread in SPX. This is something I'd consider doing today. Here's an example of SPX at 27.60. This is more in the speculative part of the portfolio. SPX at 27.60. I'm buying 2 28.25 calls, and the calls have a delta of 14, and I'm selling 1 Feb 12 27.90 call. My shorts have about a 32 delta. So Feb 12, this is what, about 28 days out, 29 days out, and I like this in a low VIX environment. And so you can see here's the price, 27.60 of SPX. I'm buying the 28.25s, that's this part of it, of the graph. The green graph is the expiration graph, and I'm selling the 27.90. So, and I'm bringing in a credit of $4.30. So as long as we don't, basically, if we're 27 or 27.90 and under at expiration, you collect the entire credit. The capital on this trade is about, was it about $3 grand, something like that. Over 27.90, if we would talk a little bit about the risk management, at expiration, you don't want it to be sitting there at the long strike, but before that, you do great if we go up. So anyways, I just wanted to give you a feel today. We went quick, but I wanted to give you a little bit of an overview of the types of things we'll be talking about. I think they're very crucial for this portfolio class to start the year. So folks, I look forward to you 2 weeks from today. The first class starts Wednesday the 17th. The class is 197, and it'll be probably 4 to 6 hours of live content. And we're focusing right now, how would we set up a market, a kind of a portfolio for 2018, and what would cause us to tweak it, and just give you a good overview to help you start out right and navigate through 2018. So I appreciate it, folks. Thanks for stopping by. I look forward to seeing a bunch of you 2 weeks from today. You can go on our website, SheridanMentoring.com, and sign up, and look forward to seeing you. One thing I want to throw out, I will be in Huntington Beach speaking at the Huntington Beach Central Library. For anybody out in that area, the Orange County area, I'll be out there January 26th in the morning. So if you're interested, you can see some information on our website. Have a great day, folks. Sign up for this important class, and we'll see you 2 weeks from today. Thanks.